The bullish freight train just keeps chugging higher as the S&P 500 was up another 1.5% today, largely due to Meta slash Facebook having one of its best days in history. It was up over 20% today, and that lit a fire under all the FANG-related names, especially all those mega cap growth-oriented areas did particularly well today. But oddly enough, there was a big part of the market that sat out today's rally. In fact, the Dow Jones Industrial Average finished the day a little bit lower today. So we're going to talk about a number of those trends that we've seen develop before our very eyes here in the last several weeks during these free YouTube videos that David and I produce for you, and kind of see some of the breakout areas on the charts that would have made sense to add exposure to. We're also going to look at themes within a macro perspective, take a look at what's happening with interest rates. We're going to take a look at factor analysis, looking at the low size factor in particular breaking out in a big way. And then we're going to do some sector analysis looking at communications, discretionary, and technology really rocketing to the upside and leaving the rest of the market in the dust. Then lastly, we're going to talk about our trade application example, where I wanted to focus on a dividend king in a somewhat out of favor area on a relative basis at least, but this particular stock happens to be bouncing up and off of its 30-day moving average, so I thought I'd try to take advantage of that with a bullish trade. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's February 2nd, 2023. Happy Groundhog's Day to everyone out there. Remember, if you're new to our channel, be sure to click subscribe, and then make sure you also go into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. In addition to that, we're heavy users of Twitter. If you're not doing so already, make sure you're following me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And my, oh my, the bulls keep roaring. This is actually a little bit more red on the screen than I had anticipated, judging by the market activity today. Most of the major indices were up over 1%, but we actually had quite a healthy rotation taking place underneath the surface. I remember we had a day like that last year as well, and it did lead to some further switching of hands in terms of money rotating from one area to the other. And today it had a feel of more push into the growth-oriented areas, largely because of Meta slash Facebook, whatever you want to call that these days. But it had one of its biggest days in history. I think it was either the best or the second best day it has ever had as a publicly traded company. It was up 23% today. And so that lit a fire under the FANG-related types of names that are out there. You can see Alphabet was up tremendously here in the normal session. I'll get to that later because they're reporting earnings after the bell tonight. But in the normal session, Alphabet was up 7% today. We also saw that Apple was up 3.7% today. We saw Microsoft was up 4.7% today. Amazon was up 7% today. Tesla was up nearly 4% today. So, and then, not to be outdone, we've got Nvidia kind of pulling its weight over here, up about 3.6% today as well. Netflix did okay. They were up over 1%. But the point is, that was kind of your FANG-related trade right there, right? The mega cap growth-focused area was definitely in favor today. But oddly enough, outside of that kind of specific group, it was definitely more hit and miss here today than you would have expected. But remember that the way that the S&P 500 is calculated, it's a market cap weighted index, meaning that the bigger these squares are, the more influential they are on the overall end results of the S&P 500. So we had a few days last year where it was those specific companies that were out of favor, yet most of the other stocks were in favor, and it was kind of masked by the end result of the S&P 500 having a little bit more of a whimper type of a day, right? We had a few of those types of days last year when those FANG stocks were out of favor. Well, here's the exact opposite. Today was a day when they were very much in favor, extraordinary numbers in the case of, Alphabet and Meta and Amazon in particular, and they really carried the weight of the whole market here today. If you were to just somehow magically get rid of those stocks, those big mega cap growth-oriented names, and just look at the rest of the market, it was a bit of a meh type of day. In fact, I would go as far as saying it was aggressively bearish in some cases. Sadly, for me, as a dividend investor, it was a tougher day for dividend investors. And remember, that's been an ongoing theme so far in 2023. We were blessed with a lot of outperformance as dividend growth investors in 2022 when everybody else was licking their wounds. But this year it's been kind of the opposite, where those growth stocks have burst back tremendously, and many of the dividend stocks have really lagged behind. In some cases, they're actually down on the year. And so today kind of felt like that was much of the same type of stuff, maybe to a little bit more of a stark degree today because of the end result of the S&P 500. Nonetheless, it kind of continued on that pathway, what we've already recognized so far early on here in calendar year 2023. So beyond those big stocks that I rattled off there that were up tremendously, you'll notice there were a lot of brighter red squares on the board here as well, including United Healthcare was down over 5%, Eli Lilly was down 3.5%, Merck was down almost 3.5%. We saw AbbVie down over 1%, CVS down over 1%. John Deere took it across the chin today. That had been a big winner last year, but it got smashed today, down about 5%. We saw a lot of the insurance-related names had to chuckle because the last couple of days Chubb has really struggled. And I was just talking about Chubb on Tuesday with you guys, saying how it was such a quiet performer to the upside, and then it got schnocked the next day, and today it didn't really follow through either, down another 1.5%. But speaking of aristocrats that are insurance companies, Aflac was down about 6% today, one of the worst performers in the market. Travelers did not do particularly well, down about 2%. MetLife was down about 4%. So the insurance area really struggled here today. And remember, that was another theme last year that did really well. We saw a lot of the consumer staples, a lot of the healthcare companies, and the insurance companies do extremely well last year on a relative basis, especially. And in some cases, they were up tremendously last year in a year when, the stock market itself was struggling mightily. So again, just another proof in the pudding there that this year is almost acting like an exact opposite of what we saw last year. And speaking of which, to continue that theme, down below, notice energy really struggled here today. Remember, that was one of the better performing areas of the market last year as well, but they certainly fell out of favor, and that has been a continued theme that we've seen a little bit more so here in the last few weeks, where last year it was the energy stocks that continually held up better than expected. This year it seems like they're using that as an opportunity to kind of slip lower. And then also remember last year we talked a lot about the defense contracting stocks. Today they were out of favor as well. Raytheon and Lockheed Martin and Boeing, some of those companies really slipping here along the way. Other areas that were kind of in the green, I would say real estate did tremendously well, right? We talked about that a little bit in the presentation on Tuesday, where I was talking about how last year we saw the REITs really get smoked. And, especially at near the end of the year. In fact, we had a good conversation about this in my question and answer session earlier today when somebody had asked me about REITs. And I was explaining how last year, between September and the end of December, we bought 5 REITs in my dividend growth investing account. And to put that into perspective, we build out 25 stock portfolios. And it started last year in late June. We did not buy our first REIT until the beginning of September. And then after that point, we ended up buying 4 more. So for a total of 5 REITs. So in a 25 stock portfolio, we had 5 of them in one sector, REITs, because they were so out of favor last year. And here so far this year, they've been ripping higher. So, those of us that put that portfolio together last year in that DGI class account here at Market Scholars, we have been thrilled with the performance of the REITs so far this year, since 20% of our money was allocated to this one sector last year. And that is very rare, by the way, as well. I mentioned that on Tuesday, but just to reiterate, this is the first time in history. And remember, I've been doing this a long time. There's been 9 years worth of dividend portfolios that I've put together for my students, both here at Market Scholars and previously at InvestTools/TD Ameritrade when I was with them. And last year was the very first time that we ever put 5 out of our 25 stocks in the REIT sector. We've done that occasionally with other sectors like consumer staples, but never with REITs. REITs are usually not the best place for dividend growth because of their requirements to pay out 90% of their net income as dividends. So it made it even more peculiar last year that we were so hyper-focused on the REITs when they were just getting blasted at the end of last year. And then we fast forward to what we're dealing with here right now, and they are just going crazy to the upside. It's been quite remarkable, to be honest with you. So number of great moves today. Essex, a dividend aristocrat in the REIT space, it was up 4%. Extra Space Storage was also up 4% today in the self-storage area. Digital Realty, which is one of those data center REITs, was up over 3% today. CCI, one of the cell phone tower REITs, was up over 2% today. We had some of the office REITs over here like Vornado and Boston Properties and Alexandria up over 4%. So this is a kind of a sneaky strong area. You know, it's the FANG stocks got all the press today, but don't overlook the REITs. They are just rocking it right now in a big, big way. To kind of put that into perspective a little bit more, just to show you what the chart looks like on something like XLRE, which will show you the REITs. Notice here that so far just this year, if we were to kind of zoom in on just this year's activity, these bars down below will show you how often they were up and how much they were up. And you can see some massive bars here, like on January 4th, the entire REIT sector was up over 2% because you can see it's going up and over that orange line right there. And then a couple of days later on January 6th, the entire REIT sector was up basically 3%. And then a few days after that, the entire REIT sector was up over 3%. And then you can see some of these other days along the way where another 1% up day, another 1% up day, another 1% up day, nearly a 2% up day, and today it was up over 2% again. So I kind of get the sense that not a lot of people are talking about the REITs. It's a quieter area. It doesn't come with a lot of market cap, but there are some aggressive moves taking place in that area right now. So any folks that would have taken advantage of that big dip that the market was giving us last year in the real estate investment trust world probably has a nice smile on their face here fast forward till today. So that was pretty much what I wanted to share with you on the heat map here today. The big theme was FANG-related stocks up huge, and since they're still the most influential in the market, it made it look as though the market was up huge today as well. But if you were to strip away those FANG-related names, it was more of a toss-up as to whether your favorite area of the market was doing well or not. But it does seem to be a continued theme of rotating out of last year's winners and into last year's losers for the most part. Let's take a look at some of the actual market breadth numbers now. Coming over here to the Market Watch tab, you can see that we've got 326 out of the S&P 500 closing in the green today. So that was good for about a 65% hit rate. And again, we were up 1.5% on the S&P 500 today. Normally, when you have a day that with that aggressive of an end result, your market breadth numbers are better than what we saw today. So you can send your thank you cards to all the FANG-related names here today. So that's the good news as of what happened today with those bigger companies. Here's the bad news, and I hate to be the bearer of bad news, but it is what it is. Don't kill the messenger. After hours tonight, we are seeing a reversal of fortune. It's not massive, so as of this moment, it's not like we're expecting a huge gap down tomorrow of 3% or something like that. Remember, we had a few of those moments last year, but we did have a lot of companies reporting earnings after the bell tonight. Remember, this is one of the bigger days that you'll ever experience because you had Apple, Alphabet, and Amazon all reporting after the bell here tonight. So let's go through a few of those earnings reports just to kind of get a feel for what to expect when we come into the market tomorrow. Let me first start by showing you SPY to give you a sense of where we are after hours, just so I don't spook you too much here, because the SPY closed at just under 417 when we ended today, up nearly 1.5%. And you can see after hours, we're trading down about $2 per share on that ETF there. So trading right around 414 and a half right now. So again, not a disaster. Remember, that's not a huge move on a percentage basis. Yes, we're down after hours, but it's not one of those, panic types of situations right now. And you have to also remember, we have had a massive run up in the market so far this year. So to only give back a couple of bucks on SPY when there were so many disappointments after hours, I think is actually a little bit of a win for the market, quite frankly. But let's go through some of those names so that way you're prepared for tomorrow morning as well. Of course, the big kahuna out there is still Apple. It is the biggest publicly traded company in the United States. And as you can see, it's struggling a little bit after hours. It closed today's session at just under 151. And so far, it's been a little bit of a give back in the after hour session after they have reported their earnings. They're trading at about 146 right now. So remember, they're the most influential member of the S&P 500, so that's already going to have a little bit of a negative tilt to the markets right out of the gate. So they traded as low as 140 at one point in the after hours. They've recovered some of those losses. In fact, after going down to nearly 140, they basically recovered all the losses right here in this move. I know that's really hard for some of you guys to see because I'm on my tiny miniature 1 day, 1 minute chart here. But you had this 152 print immediately after hours. Then we printed the low of 140 maybe about a half an hour or so after that. We actually recovered all of those losses, and we were trading back up to about 151 before now rolling over yet again. So a little bit of volatility there after hours with Apple, but nonetheless, it's not a disaster at the same time. So, that's the good news. Let's take a look at Amazon next. Amazon, similar to Apple, a bit of a disappointment here after hours. You can see Amazon was one of those high flyers today, ending the regular session up about 7%, a massive day, nearly closing at $113. But after hours here, you can see we've slipped down to about 107 or 108. So giving back some of those gains from today, but still better off than where we were yesterday after yesterday's close. So a lot of people will look at this and say, "Oh my gosh, Amazon's down so much after hours." Well, keep context into the back of your mind there and have some perspective. It's still higher than where it was at yesterday's close. So it's just basically giving back a big portion of today's enormous gains that were already had. And then Google is, of course, the third of the big three. And Google/Alphabet is what they call it these days. Closed today at 107. It was also up about 7% today. It's giving back some of those gains in the after hours after reporting earnings and is now currently trading at close to 103. So it didn't quite breach $100 per share in the after hours, but it got close to that and then kind of rebounded there as well. So anyway, those are the big three and the most influential. And since all three of them are trading lower at this point in the after hours session, then that's going to likely pressure the S&P 500 and the NASDAQ first thing tomorrow morning. They weren't alone. There are some other companies reporting after hours tonight. Let's take a look at Qualcomm. QCOM, which is, of course, still a very important semiconductor company focused on mobile, computing and things like that here in the U.S. especially. But Qualcomm is trading lower as well. They closed the normal session at about 136. They're currently trading at about 131, so a bit of a give back for Qualcomm as well. That's not going to help the NASDAQ tomorrow morning. Let's see, who else? We had Ford report after hours. Similar conversation. This is another one that's trading lower. It ended the normal session up at 1432. It's trading just a hair below 1350 in the after hours session. I think I did hear that Ford is issuing a special dividend, so that might be of interest to some of you. Oddly enough, we've never bought any automobile companies in my dividend classes over the last 9 years, either General Motors or Ford. Not to say that you couldn't have done well with them from time to time, but in general, they just haven't been as consistent consistent of dividend raising companies as we would like. But nonetheless, it's good to see them being a little bit generous with a special dividend payout there for their shareholders. Let's see who else was reporting after hours tonight. Starbucks. So Starbucks also trading just a hair lower here in the after-hour session. It ended the day at 109. Oddly enough, it didn't even finish the day higher today. So it was one of those that was on the wrong side of the equation. As a dividend growth stock, it was kind of struggling here today because it did okay last year. It wasn't one of the big winners, but it had a nice run into the end of the year. So gave back a little bit of that here today, and then giving back a little bit further of that here in the after-hours session. Not a big deal, but trading just a little bit below 107 in the after hours. Speaking of dividend growth stocks, let's talk about Clorox. Here's one of the rare bright spots in the after-hours session. A lot of people have wanted to give up on Clorox here in recent years. Of course, they were one of the poster children of the COVID era, as all those Clorox wipes were being gobbled up out of the store shelves out there. And then they got kind of caught a little bit flat-footed with not enough inventory, so they decided to try to correct that inventory by building out a lot more production in factories and things like that, just in time for the world to realize Clorox wipes aren't really all that helpful in battling against COVID. So they've had their own managerial issues to work through here in the last couple of years, but they are still a dividend aristocrat, dividend king type of a company. Their yield in excess of 3% right now, and still worthy of consideration from my perspective. It's kind of an old school type of a company. And you can see they ended the normal session at 141. They're trading up here closer to 147 right now in the after hours session. So finally we get one on the opposite side of the equation going higher after hours here. Of course, not the most influential company out there, but nonetheless, at least some positivity in the after hours session. And then let's also take a look at Gilead Sciences, another dividend growth company that we've talked about quite a bit in my DGI classes over the years. Many of you probably own this one. It ended the normal session at about $81.39. After hours here, it is up at about $85. Just a barely above that. So like Clorox, another one that was down in the normal session, but up in the after hours session, which is kind of the opposite of those others we were talking about. Google and all them were up big in the normal session, but down big in the after hours session. So a little bit of a role reversal there with some of these. And by the way, I posted this to Twitter as well, so some of you probably saw that already, but just in case you don't follow me on Twitter, Gilead did raise their dividend here after hours tonight as well. We are in the thick of it from a dividend increase announcement perspective. I'm sure some of you are probably getting sick of seeing all of my dividend increase announcements on Twitter, because this is that time of year where many of the boards of directors are getting together and making those decisions. Usually quiets down later as we go forward throughout the year, but at the beginning of the year, we have dozens, if not hundreds per month of dividend increase announcements. So Gilead came out and boosted their dividend here after hours, and perhaps that's assisting the stock and pushing it a bit higher there as well. So a bit of a mixed bag after hours with the earnings announcement, but in general, I would say it has a decidedly bearish tilt when you're factoring in the market cap aspect of it, with the biggest market cap companies down pretty significantly after hours. So I would expect that tomorrow morning we'll probably wake up to futures in the red, but as of this moment in time, it doesn't look awful out there. It looks like it is a fairly manageable give back at this point. We never know when that sort of thing starts spiraling out of control, but as of right now, it seems like the market is at least taking these earnings reports in stride. Let's take a look at some charts here. I want to pull up SPX on chart 6D. Remember, whenever we have a move of 1% either up or down, I like to start off with this chart just to give you a sense of where we've come from and what kind of volatility we've been dealing with and different things like that. And you can see here in the middle where you see these green and red bars, they will show you when we've been up a lot versus when we've been down a lot. And one thing that is apparent to me is we have a lot more of these robust green bars to the upside stretching beyond this blue horizontal line, telling us that those are days where the market is up over 1%. We have way more of those recently than we have the opposite of these red bars down below the blue line, down below the zero line right there, right? So, so far this year, we only have 1, 2, three 1% down days in the S&P 500. Meanwhile, on the upside, we have 1, 2, 3, 4, 5, 6, 7, 8. So 3 1% or more down days, but 8 1% or more up days. And like I mentioned here on Twitter just a moment ago, some of you might have seen that tweet where I was talking about the Russell 2000. It's even more dramatic there. If you were to pull up the RUT here, you can see that we've actually been up over 1% on 10 days this year. And many of those, we weren't up just 1%, we were up 2%. So out of those 10 days that were up at least 1%, 4 of those stretched beyond a 2% advance there for the Russell 2000. Remember, there's only been 22 trading days so far in this calendar year. So 10 out of those 22 days, the Russell 2000 has been up at least 1%, and 4 of those 22 days, the Russell 2000 has been up at least 2%. So it has been rather remarkable to see that. I take that back. It might have only been 3 of those. I might have counted that one by mistake, but that one technically was on December 29th. So sorry about that. I thought that was in this calendar year, but my eye deceived me. So 3 out of those 10 days were at least 2% to the upside, which is still phenomenal to think about, right? So the Russell has been impressive to say the least. Let's go ahead and take a look at our foregrid now. And you can see some of the numbers and what the charts look like after such an enormous day here. The S&P 500 was up 1.47% today. The Dow Jones, believe it or not, was actually down today. Not by much, but it was down by 0.11%. So it had a rare red candle here today. And again, that's where you're going to find those big blue chip, old school dividend types of companies that did reasonably well last year. They are sitting out this rally where there is a decided push back into the growth names. And then down below, you have the NASDAQ composite leading the way today, up 3.25%. Remember, that's largely due to Meta. Remember, the NASDAQ and the Russell 2000 we think of as more speculative areas than the two charts up above. But the Russell 2000, it was only up 2% today. Still a great day, but it had a hard time keeping up with the NASDAQ because of what was today's leaders. And as I mentioned on the heat map, it was the FANG-related names. Those are not companies you find in the Russell 2000, right? The Russell 2000 are your smallest companies out there. So Meta and Amazon and Alphabet and all those companies that were just roaring higher today, they had a huge influence in the NASDAQ composite here today. So same thing that I mentioned to you on Tuesday, we're still in bullish postures across the board, and we do have price above rising moving averages across the board as well. That has been the case here this week for all of these indices. And we were also talking about on Tuesday, I was saying how it really wouldn't take much for us to get a breakout in the S&P 500, because on Tuesday, remember, I was looking at the chart on that candle right there. I did not know what was to come in the last couple of days since then, but I said, we are very, very close to these prior resistance areas, so it really wouldn't take much for a breakout. And fortunately, Jerome Powell delivered just what the bulls needed. Yesterday, he came out and, of course, raised interest rates by a further 25 basis points, but he really didn't talk tough at all. He kind of gave us a little bit of a whimper saying, you know what, it's okay. Inflation is, somewhat under control, and we've done a lot of work towards that. And while we don't have any plans to stop raising interest rates right now, we don't plan on raising them aggressively from this point forward like we were used to last year with the 75 and 50 basis points types of moves. So that is exactly what the stock market apparently wanted to hear, and off to the races for the last couple of days as a result. So we clearly have a breakout here in the S&P 500. We clearly have a breakout down below here in the NASDAQ composite, and we clearly have a breakout down below here in the Russell 2000. The only place we don't have a breakout is the Dow Jones. Part of the reason behind that might be because the Dow Jones really outperformed the other indices at the end of last year, so they already got to a heightened place, and therefore any sort of positive vibrations that have gotten into them need to be taken in consideration with the gains that already happened for the Dow Jones at the end of last year. Whereas a lot of these other indices, like the NASDAQ and what have you, they struggled on a relative basis last year. So it makes this move that they've had look a lot more impressive than perhaps they kind of deserve to, because they lost more last year. Remember, the NASDAQ was down 33% last year. So, despite what looks like a massive breakout here with the NASDAQ, look at the labels up at the top. Over the last year, the NASDAQ is still down about 15%, whereas you look at the Dow Jones with no breakout on the chart, yet it's only down 4% over the last year. So the Dow Jones is still destroying the NASDAQ on a year-over-year basis. It's just like the NASDAQ is playing a massive amount of catch-up here in the short term. So that's where the money is rotating to at the moment. So really, really impressive day. None of these have overbought cluster signals, by the way. I imagine that when I send out tonight's email, there'll probably be plenty of individual stocks that have overbought cluster signals, but right now on an index level, we're not seeing that. Now keep in mind, tomorrow is the first Friday of the month. That's an important day because we get to hear about, some jobs and employment information, and so that could also have some impact on trading first thing in the morning, in addition to what we are hearing here after hours with all of these earnings announcements. But as you look at these charts, there's not much not to like, right? These are bullish looking charts right now, massive breakouts, all over the place. And it kind of gives you the impression that it's leaving the bears in the dust. And, the bears might be nervous about that, right? You've heard the phrase that the markets tend to climb the wall of worry. Well, that's exactly what's taking place right now. And it's happening at such an aggressive pace that it's probably making a lot of people that are on the wrong side of the trade quite nervous about how this is shaping up at the moment, regardless of whether you think it's deserved or not, right? And that's the whole point of staring at the charts, is we don't have to rely upon what we think should be happening. We can just react to what is happening. And what is happening right now is breakouts all over the place for the bulls. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these free presentations that you find on YouTube, and the place where I try to go and gather up as much information as possible to determine whether these videos are being well received and supported or not is on Twitter. That is the social media area that I tend to hang out on the most during the day. I'm not much of a Facebook guy or a Snapchat guy or, what's the new one, TikTok. Not really my jam, but I do enjoy being here on Twitter. There's a lot of great information here. It's helped me become a better investor as time has gone forward, and I imagine that the same thing can be said from many of you as well. So this is my easiest way to check as to whether we are being effective with these free videos that we spend so much time producing for you guys. So I always say, hey, if you're willing to support the video, I'm willing to give a greater effort than I would have otherwise. And so as long as we're up and over 100 likes on the most recent market outlook related tweet that I've produced, then I'm happy to give you a full-length, hour-long type of a full-fledged video the next time I'm scheduled to do the video. Remember, I do the videos typically Tuesdays and Thursdays. Since you guys were way up and over 100, in this case 112, that's why we're in the midst of doing a full-fledged video. Remember, if you prefer the shorter videos where I only do a quick little presentation on the 4 indices, where I'm in and out within 15 minutes without all the extras, without all the 12 grids and the trade application examples and all that kind of stuff, then don't click like, because if we're under 100 likes, then I'll just plan on doing a very, very short video for you the next time around. So it's up to you. If you like these longer form ones, I'm happy to put in that extra effort for you, as long as you're willing to put in 5 seconds worth of effort for me and click a button for free. So let's see who was willing to do that for me last time around. And you can see that my friend Brandon Walker, of course, is helping me along with that. There's Ann, there's Sandeep, we've got Irene, we've got Ron, we've got Arth, we've got BZ, we've got AC, we've got Steven, we've got Tom and Jim and Lucius and Scott. There's my buddy Dividend Hike. He's a good account, by the way, for those of you that like to find stocks that are raising their dividends. There's John. There's Marty. Some of you might not know, but Marty is a great meteorologist. For those of you in the New York area, make sure you check him out. We've got Sonia. We've got Adam and Maria and Fun Jonesy and Roger and Paul and Curdy and Zerbero. And there's Christopher. I was chatting with Christopher the other day. He said, "Did you see that Mobileye trade that you talked about in the video the other night?" I'm like, "Oh yeah, I saw it." Sometimes kick myself for some of the trades I didn't take, right? But Mobileye rocking it here the last couple of days as well. There's Brian and Nikolai and Ayakipa and Dave and so on and so forth. Can't get to all of you, but I do always want to acknowledge that I appreciate those of you that go out of your way to help us along and support these videos as well. Remember, it allows David and I to get these videos out to a much larger audience than we would otherwise if you guys are willing to like and retweet and do that kind of stuff on social media for us. So thank you very much for doing that. Let's also have a chat about what we were doing here at Market Scholars today. David taught his portfolio management with ETFs class, and then I taught my question and answer session. So remember, both David and I teach 5 classes every week for our premium members. 4 out of those 5 classes are trading rooms where we're building out portfolios like I do with dividend growth investing and some of the other stuff that I do. And then our 5th class that we teach our premium members is a question and answer session class where our members get to ask us questions and pick our brain and try to get our insight on various topics. And so some of the things that we discussed today, we had a long conversation about corporate debt. We really had to do some digging there for Dr. Bob, looking at some of the floating interest rate versus fixed interest rate conversations, and then also long-term debt versus short-term debt. So we had a long conversation about, things like credit rating agencies and the areas of the investor relations areas of websites where you need to go to find that type of information, and how to kind of think about that in regards to dividend growth investing. I also got a question about buybacks at Chevron and whether we should be concerned that Congress appears to be concerned about that. I always try to be careful around those topics because I don't want to get too political in one direction or another, but I was happy to share my thoughts with Eugene on that topic. I also got a question about REITs, right? So I mentioned that earlier. So talking about the beaten down REIT sector, and I said, well, you got to be careful with that. It's not so beaten down anymore. The REITs have been exploding here higher in recent weeks. So it was true that last year they were beaten down, when that's when we were getting aggressive with purchasing them when they were out of favor. And now we're just enjoying watching them go higher as everybody else piles into them. I also got a question about some of the CRISPR stocks. They were on fire here today as well. Those are the types of companies that money is rotating back into, right? Those were a lot of the types of growth-oriented names that were really out of favor last year, more the innovative, disruptive types of companies. And so they had a nice bid here today, some of them up double-digit percentages. We also got a question about looking at Hewlett-Packard as a dividend growth investing candidate. I also got a question about ABR, which is kind of a mixed real estate / financing type of a company, and what to look out for when some companies have yields as high as 10 and 11%, which is not always my favorite types of yields. Nonetheless, had a conversation about that. And then we had a conversation about, looking at some companies where their earnings didn't look so good and wondering about evaluating the likelihood of a company that might have to cut their dividend. And interestingly enough, it was Dean who was asking me this question today. And less than a month ago, he had asked me a question on a different company in the same regard. And I just got done posting that on Twitter for those of you that might want to see that analysis. But I had mentioned that, in my Q&A class today, a premium member of Market Scholars thanked me for an answer I gave him about Hanes Brands less than a month ago. On January 5th, he asked me that question. And I posted the video, a snippet of that particular presentation. So if you're kind of wondering what types of things we talk about in my Q&A class and you're not currently a premium member, you're welcome to check that out on my Twitter feed that I posted it there today. But I basically told him it's a hard pass for me and I can't trust the dividend. Now, I didn't know it at that time because I don't have any way to predict the future. But lo and behold, here we are less than a month later. Hanes Brands was down 28% today, absolutely getting annihilated. One of the worst stocks in the entire market today. And the reason? They decided to eliminate their dividend. And so Dean was nice enough to say thank you to me here today because, I kind of guided him in such a way. Remember, I can't give advice or recommendations or anything like that, but I was more than willing to give him my opinion that is one that you probably should stay far away from if you're looking for dividend growth. And so luckily, that one was one that many of us have avoided despite what appeared to be an attractive situation with such a high yield and such a well-known company behind it, but I just simply did not trust that dividend. And today is proof in the pudding as to why I had some of my distrust there. So remember, sometimes you get accolades for the great stocks that you picked, right? It's a lot easier to see, hey, you recommend, or not, you didn't recommend, but you suggested this company, or the class voted for this company, and look at it now, it's up a lot. But remember, some of your best investing decisions are actually what you intentionally chose not to do, right? In this case, people would have saved themselves a lot of heartache and pain by avoiding Hanesbrands and intentionally deciding not to buy it, and that can be equally as effective as choosing to buy another type of a company that goes up 20% in a day, right? So it's kind of an interesting example of how sometimes your hesitations around the various setups out there can be quite rewarding when you choose not to take action. Also, over here on our website, I did post the factor selector. We use this in my factor selector, or my factor-based swing trading class on Wednesday mornings for our premium members. And it's a slightly different take than looking at the sector selector. But like I mentioned in my class yesterday, and I'll mention to you guys here in this free video as well, it basically is confirming some of the same things that the sector selector was talking about, right? For those of you that watched the video on Tuesday, which is quite a few of you, judging by all the folks that clicked like, remember what I was saying about the sector selector and how we had the 3 perfect sectors at the top of the sector selector, and all 3 of the bottom sectors were the ones we wanted down there, where we had the growth-oriented sectors at the top, things like technology, discretionary, and communications, and at the bottom we had the old school areas like staples and utilities. Well, the factor selector here is effectively telling us that same story with slightly different information. In this case, you'll notice that the speculative factor of low size, remember these are your tiny companies, the ones that can move very, very quickly because oftentimes they have very low share prices and things like that. So that has dominated here for the last 3 weeks. And remember, that's effectively right when we started noticing the Russell 2000 outperforming other areas. Remember, the Russell 2000 and the low size factor are effectively one and the same. They are tracking the same types of companies. And then on the downside, you have one of the most defensive factors out there, low volatility. That's where you're going to find a lot of utilities and boring business models. So that's what you want to see, a speculative factor at the top and old school defensive factors at the bottom. So back on over here to the charts now. Remember on the Russell 2000, which aligns itself very nicely with the low size factor, let's see if I can find the day that I was talking about this with you guys, because it's been a while now. I think it was this day right here. That would have been the 12th of January, and I believe that would have been the day I was doing this video, since again I do the videos on Tuesdays and Thursdays, so I bet that was it. On the 12th of January, I was pointing this out to you because I thought it was useful information. And it doesn't always work out that, what I think is useful information is usable for you, but in this case, I think it would have been. So if we back it up a second, let's look at where we were at on January 12th right here on the Russell 2000. Like if I just zoom in only on that day and then go up above here on the Dow Jones on the 12th and kind of zoom in from that day on, here's kind of what we were looking at with those two. And the reason I selected this day and the reason I brought it up that day is this was the day where we had what I would determine to be a baton handoff. Prior to this day, I was saying that the Dow Jones was our leader, but after this day, I was saying we have now had an official baton handoff we now have the Russell 2000 as our leader. And the reason that I made that comment that day is because of where the intermediate line was on the market forecast. It's kind of hard for me to explain because it's a little bit easier, especially for those of you that have smaller screens, just to look at the label right here that I'm circling. But remember, that's today's reading. But there's a little green number above the green label that if you point at a candle, you'll see what the intermediate reading was on that day. So as I go back and point at the candle on January 12th, I'll read it out to you in case you can't read it on the recording here. The Russell 2000 on that day was 59.1. Okay, so keep that number in mind. And then I come up here and do the same thing on the Dow Jones, and it was 57.49. So in other words, the 59 reading on the Russell was bigger than the 57 reading on the Dow Jones. Now the day before, I don't believe that was the case. Let's just double check. On the day before, the reading on the Dow was 45.7, and the day before on the Russell was 45.17. So just by the slimmest of margins, the Dow had a slightly bigger intermediate reading on January 11th. But on January 12th, that changed. And I notified you guys of that immediately. Now, as we fast forward from that point forward, so let's look at where the 12th was and only zoom in after that now, after recognizing that. So that's what the Dow looks like since that moment in time. And let's do the same thing down below on the Russell 2000. And where's the 12th? There it is. And just zoom in to the right now. Look at how different those two indices look. The Dow is basically flat, right? Here was the first candle on the 12th. Look at where we're at right now on February 2nd. We are almost identically to where we were trading on that day. In fact, we might be a little bit lower. I bet we are, because the closing price that day was 33,792. And today's closing price is 34,000. I'm sorry, let me read that again. I was reading the low number, my apologies. The closing price, so what I want to look at here is that C colon above the chart. On this day on the 12th, the closing price for the Dow was 34,189. Today's closing price is 34,094. So we are barely moved at all from that day. We are actually down just a touch from the closing prices of January 12th. Think about that for a second. We're talking about all these bullish breakouts and all this, the bullish party's back and everybody's enthusiastic about the market. Well, since January 12th, the Dow is actually lower. Think about that. That's amazing to me in the context of what feels like this huge party that the stock market is throwing this year. The Dow is down from that day where I said that there was a baton pass. And let's now compare that to what's happening with the Russell 2000. On that day, the closing price of the Russell 2000 was 1,876. Today, we closed above 2,000. So we have gone up basically 125 points on the Russell 2000. That's a huge move, right? To put that into perspective, let's do a little math here. 125 points divided by that starting point of 1876, and the Russell 2000's up 6% in just that amount of time from January 12th to where we're at right now. Meanwhile, the Dow is actually down just a hair. So if that doesn't, show you that there is some major diversions happening within the market right now, I don't know what does or what will. We are seeing some immense strength in certain areas of the market, whereas other areas of the market are not participating at all. So I found that to be quite fascinating, to say the least. Let's do some 12 grid analysis now, and let's kind of get a sense of what's happening with the asset classes out there. And when we pull up this first chart, 5A, you'll notice that we have 3 pink charts on the board, and they're all on the bottom. And it's the bottom 2 corners that kind of have been influencing markets so much over the last year or so. And when they are out of favor, the rest of the market seems to be in favor. So we kind of like it when the bottom 2 corners have the red colors. in this case, it's the U.S. dollar that is down in the lower left-hand corner, and the 10-year Treasury yield that is bearish in the lower right-hand corner. Now, technically, the dollar was up a little bit today, 0.66%, but because it's been in such a significant downtrend, it was not enough to force that posture to shift back to bullish. You can see it's obviously still trading below a falling moving average as well. Treasury yields were basically flat here today, but they got whammed pretty hard here the last couple of days after hearing Jerome Powell's commentary there. So this is their third straight day to the downside on the yield side of the equation. And you can see that today on an intraday basis, we touched multi-month lows on Treasury yields. The 10-year is now at 3.39%. Remember that the 3-month Treasury bills are actually still yielding about 7% right now. That is just unreal to see the differences between the long end and the short end of the curve right now. You'll notice that oil also has a light pink background color, but remember that's only considered weakly bearish, not strongly bearish. So we're not going to read too much into it, but be aware that they have been down. Oil itself has been down 4 out of the last 5 days, and it had a pretty healthy give back of over 1% today, and we are now back below, in this case, a rising 30-day moving average on oil. Gold also struggled today. That was a little bit more surprising, but remember the dollar was up. So a lot of times when the dollar is up, gold is down, and that was the case here today. Despite being down somewhat aggressively, that was a 2% give back. Remember, just yesterday we had an overbought cluster signal, so we probably got a little bit too overheated here in the short term. So we should maybe not be too surprised that gold needs to take a little bit of a breather here or there. But you'll notice that we are still a long ways from even touching the 30-day moving average. That's how robustly bullish gold has been this year. So we did have a pretty healthy give back today, but it is definitely not a trend changing type of a give back. We continue to have strongly bullish posture on gold, prices above a rising moving average. Bitcoin is hanging out about $23,500, so it's higher than where it was over the last week, and of course is up tremendously from where we started the year, way down here. It continues to have a strongly bullish posture. All of the bond categories continue to have strongly bullish postures. Notice that high yield bonds actually printed an overbought cluster signal today, so maybe we need a little bit of cooling off in that area before we can have a further advance. Up at the top, foreign markets were actually down today, again, probably because the US dollar was up. US dollar is up. The foreign markets tend to underperform on a relative basis. Both EFA and EEM were lower today, but still retain their strongly bullish postures, whereas the S&P 500 was up nicely today. And notice this is a little bit different. SPX at the index level did not close today with an overbought cluster signal, but SPY, the ETF that tracks that index, actually did. So that doesn't happen very often. Usually those two things are in unison of one another, but maybe this is telling us that we got a little bit too rambunctious with this market rally that we've been participating in here in the last several days. Let's go ahead and now take a look at our sector analysis. And no surprise, the biggest movers today were communications, discretionary, and technology, right? Those were the areas that I already told you on Tuesday when we were looking at the sector selector that were at the top of the sector selector. So just that one little hint of information of watching that free video on Tuesday might have put you guys in the right alignment, prepared for a day like today where they absolutely just took off like rocket ships. I mean, it's rare to see an entire sector up 6.6% today like we saw with the communications area, and that is in large part because of what we saw out of Meta, but of course you also had help from Google and others there as well. Tomorrow, probably a little bit of a different story, but for one day, they were the champions, and that was just a massive, massive gap up there in the communications area. Note that they did close the day with an overbought cluster signal. Technology, obviously had a very strong day as well, breaking out over these prior resistance areas. Remember, I talked about that on Tuesday as well, because that was on this candle, and I said technology's got a little bit of work to do. Well, they rolled up their sleeves and they went to work on cue. It didn't take long, and they were able to break out over those resistance areas with no sweat. And then discretionary just kind of seems like it's a runaway freight train at this point. Up, and away. 3% nice move right there out of it as well. But a lot of these other areas still look pretty good as well. Look at financials. Up there near their 3-month highs. Industrials actually went to their 3-month highs despite that negative performance out of John Deere. And then I mentioned it already, but I'll mention it again because not a lot of people talk about these things, but the REITs are just going bananas to the upside. Look at the REITs down below in the lower right-hand corner. They are taking off, man. You usually don't see these types of yield-bearing instruments, move this aggressively. But that was a 2.3% move out of the REITs today, which has continued what has been just a breathtaking move out of those types of instruments here so far in 2023, really making up for all of this negative performance at the end of last year and then some. Whereas a lot of the more traditional, defensive areas struggled on a relative basis today. You'll notice that the consumer staples were down 0.86% today. Healthcare was down 0.68% today, and then energy was the worst performer today upon those lower oil prices. The energy sector was down about 2.28% today. So at this moment, the energy sector is actually the only one with a light pink background, meaning that we've got a weakly bearish posture. All the rest have bullish postures, and the more aggressive cyclical growth-oriented ones are the ones that have the strongly bullish postures out there. All right, let's go ahead and now talk about our trade application example. For that, I'm just going to bring up our swing trading chart here, chart 3A. And I have to admit, this one was a little bit of a frustrating one for me today. Most of you know that I post the trade alerts to the market outlook trades that I do before the market closes. And usually I try to get that done somewhere between a half an hour to 15 minutes before the market closes. Today was one of those frustrating experiences where I knew I wanted to trade Abbott Labs, but the darn thing just kept on going higher, and it was so frustrating. I'm like, every time I do a cancel replace, I don't like to do market orders, so I kept on going up with a limit order, and the darn thing just kept going up. To put that into perspective, I'll show you here. On Abbott Labs. It's actually kind of hard to see, but this is kind of what I'm referencing. If I kind of zoom in on those final 15 minutes right there, this thing was down here well below 112, and it just kept on going higher and higher and higher. So my apologies for getting the trade alert out later than I would prefer today. It was still out there just barely before the market closed. Nonetheless, I know I was cutting it pretty close today, but it wasn't because I wanted to. It's because the darn thing just kept on going higher when I was trying to buy it, and I hate chasing stocks. It's not part of my personality. So I eventually had to relent to the market's whims here today, but did get the trade done. And it's just a simple bullish trade where I'm playing the bounce up and off of the moving average in this case, right? You can see that it was up today. Remember, the healthcare sector itself was down today. So this one feels like it's acting a little bit different than your traditional mega cap pharma names out there. The Lillys and the Mercks of the world, they're really suffering a lot of wear and tear on their charts right now. Abbott Labs suffered a little bit of wear and tear earlier in the year, but it's actually done pretty well the last 3 days or so, where it started to stabilize a little bit here, and we're back to that bullish near-term posture, which is what that blue background color suggests on this particular chart. You can see that Abbott Labs is still beating the S&P 500 over the last 3 months of this chart. It's up about 13% over that time period, and now that we've stabilized right around that moving average, note that the moving average is back to that green color once again after spending a little bit of time in the red and the yellow there. What that green color suggests is prices above a rising moving average. And so I just did a simple stock trade here. This is not an options related trade where I bought some stock with a stop loss a little bit below the candle there on January 31st, and my upside price target with a 1-for-1 reward risk relationship is up there just a hair below where the high price was there on this candle back on January 11th. So note that the green line has also started to tilt higher once again, so maybe that could be supportive of this trade as well. It's not just the blue line posture that's bullish, also the green line posture is helping us along in that regard. So we'll see. Obviously, no guarantees on that one, as healthcare has been struggling a little bit more than some of the other sectors, but that's kind of my paranoia coming through there as well. With a lot of those other sectors just taking off to the upside so aggressively, I have a hard time going into a bunch of bullish trades in those areas after the train has left the station, so to speak. So this is one I felt a little bit more comfortable with because it's not some sort of aggressive move higher before now. It's more of a gentle push higher. And so that might come back to bite me because it's in an area that's not necessarily in favor right now, but at least I'm not buying something that's like 20% off of its moving average or something like that. So we'll see how this one goes to kind of balance out some of those other trades that I have going right now. Okay, so that's what I had for you. Hope you enjoyed the presentation. It was another fantastic day in the stock market. The bulls are roaring. Whether it continues or not remains to be seen because, of course, we had 3 mega cap companies report what appears to be disappointing earnings after hours tonight, and we don't know at this moment in time what the reaction will be to the jobs numbers tomorrow morning. So stay tuned. I'm sure David will give you a recap over the weekend, whatever ends up happening on Friday. But if you enjoyed the presentation tonight, I have one simple request from you. Click like for me there on Twitter. As long as we're up and over 100 likes, I'll plan on doing another full-length video like this when I'm scheduled to do it on Tuesday. Until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.